Silver just ripped past $91 an ounce, and the move has been so violent that parts of the US mint silver lineup have been paused. Big box retail is slapping purchase limits on silver, and the futures market just changed the margin rules in a way that should have cooled everything down, yet silver is still climbing. So here's the question we're answering today. Are we watching the beginning of a historic reprick, or the kind of late-stage surge where something breaks? Because this isn't a slow grind higher, this is a sprint. Inventory is disappearing, spreads are widening, and the difference between a paper quote and a real metal in hand bid is getting louder by the day. Now, before we get into what the mint did, what Costco is doing, why the margin change matters, and why the East-West price split should have your attention, I want to address something quickly. I'm running a campaign to push back against copycat channels that recycle content and dilute the message. If you value what we do here, support the original work. Subscribe and comment OG John AG so I can see who's really part of this community. And because I want the real audience connected in one place, I also created a WhatsApp channel for daily updates. I'll post quick notes, important headlines, and the day's video link there, plus a few personal observations that don't always fit inside a full upload. The link is in the description. Join it so you don't miss why the gold to silver ratio matters, the fast moves when they happen. All right, let's jump in. Silver is above $91 and it's not acting like a normal commodity. Normal commodities move with patience. Silver is moving with urgency. You can see it in the intraday whips, the sudden gaps and the way dealers are reacting in real time. And gold is moving too, that matters. When gold and silver rise together, it stops being just a trade and starts looking like a monetary event. Confidence is leaking out of something else. One quick way to frame the bigger picture is the gold to silver ratio. As silver rises faster, the ratio compresses. That compression tempts people to get fancy. Swap, trade, pivot, and try to time the next leg. But let me ask you something before you do anything clever. Are you positioned for a chart or for a market that might not deliver product on time? Because those are two completely different games. Now, you're going to hear the usual explanations for why silver is ripping. Rate cuts, political drama, and geopolitical tension. And yes, those things can add fuel. Lower expected rates tend to help metals. Uncertainty tends to help metals. Institutional credibility taking hits tends to help metals, but those are the broad headlines. The more important story is what's happening under the surface, availability flows, and the mechanical pressure points that show up when paper and physical stop behaving like the same thing. And this week was a stress test. Let's start with the East versus West price split. When one major market is paying materially more than another, that's not trivia. That's the market telling you where the real bidding pressure is. If buyers in one region keep paying a rising premium for immediate metal, that metal flows toward the higher bidder. And if the premium persists, the cheap market either pays up or watches inventory get drained. That's one pathway to $100 silver without any magic. Not a meme, not a miracle candle, just real bids pulling metal. Now let's talk about the US Mint Y 7-to-1 is a big deal pause because it's being misunderstood in both directions. This is not the end of silver. What it signals is simpler. Pricing can't keep up. Some numismatic silver items were paused while pricing adjustments are evaluated. Translation, silver moved faster than their product pricing framework. That matters. When a major institution has to hit pause because input costs sprinted away from listed prices, it tells you the move isn't gentle. The pipeline is reacting. And then you zoom out to retail. Costco has quietly become one of the clearest signals in this entire cycle. When a mainstream retailer is selling out, adding purchasing limits, and struggling to keep listings available, it tells you demand is outrunning replenishment. They don't limit your cart because they're bored, they limit it because the drain is real. And here's the part a lot of people miss. Even if the spot price is the headline, the physical market is where behavior changes. Out of stock notices, shipping delays, and widening premiums are the things that turn curiosity into urgency. So if you're buying anywhere right now, expect delays, expect back orders, expect dealers to protect themselves with higher spreads. That's not price manipulation. That's logistics meeting a stampede. Now, while physical is tightening, the future side did something that should have been a cold shower. Margins. This is the technical part, but I'll keep it simple. In futures, margin is the collateral you post to control a contract. When the exchange raises margins, it becomes more expensive to hold positions, and that can force leverage traders to reduce exposure. In many cases, it slows rallies. But here's what makes this week unusual. The margin structure was changed in a way that makes margins scale with price. In other words, as silver rises, the cost to stay in the trade rises automatically. That is supposed to be a break. And yet, the price kept climbing. Circle that. That's not normal behavior because it suggests either the buying is strong enough to absorb the friction or the market is stressed enough that the usual tools aren't working the way people expect. Here's a quick metal model. A standard silver futures contract represents 5,000 ounces. At roughly $91, that's around $455,000 of notional value. If margin is around 9%, you're talking over $40,000 in silver supply reality, byproduct constraint collateral, just to hold the position. And if that collateral requirement rises as price rises, it's like a treadmill speeding up while you're already sprinting. So why would anyone stay in? Because they think the upside is bigger than the pain, or because they're hedging something bigger, or because in some cases they actually need the metal. And that last category is where markets stop respecting normal speed limits. Now you're going to hear commentators call this a mania and move on. They'll say it's a technical breakout. They'll say it's just the rate story. Neat explanations are comforting because they make the chart feel controlled. But what isn't neat is this combination. A major mint pausing products because pricing can't keep up. A massive retailer limiting purchases because inventory can't keep up. And a major futures venue changing margin mechanics while the price still pushes higher. That's not a tidy chart story. That's a system reacting. Now, silver has always been a metal that behaves politely until it doesn't. It can spend years going nowhere, humiliating both bulls and bears. It can move sideways while everything else trends. It can test your patience. And then when conditions finally line up, it can move so fast it erases months of resistance in days. That's why it creates legends. But the key question today is, what phase are we in? If this is early phase, the biggest public wave hasn't arrived yet. If this is late phase, volatility will spike, liquidity will thin, and the shakeouts will get vicious. So let's talk about participation, not just price. A true mania isn't subtle. In a true mania, the public shows up late and loud. You hear about silver from people who never cared. You see nonstop headlines. You see emotional buying. You see desperate selling. You see get-rich-Q energy everywhere. Do we have that yet? Not fully. And that's why this move is so interesting. It's powerful, but it doesn't feel fully saturated with mainstream attention. That means there may still be fuel. Now, quick reminder, because my analytics are brutal, a lot of people watch these videos and don't subscribe. If you want to support this channel and help the message spread, subscribe, then comment OG so I know you're here with the real community. And here's a cliffhanger you should sit with. Even after this run, the biggest question isn't how high can it go. The biggest question is what happens when everyone tries to buy at once, because that's when the story shifts from chart watching to supply watching. That's why I keep telling you to watch the signals that matter for physical buyers. What a ratio collapse can trigger premiums, back orders, shipping delays, purchase limits. Those are the indicators that tell you whether demand is real and whether the distribution system is getting strained. Now, I want to bring in the international angle one more time. If silver is consistently trading at a meaningful premium in a major market elsewhere, it changes incentives. Metal tends to flow where it's paid for best. And if that premium persists, it pressures the lower price region to reprick one way or another. This is why some people say paper is lagging reality. Whether you agree or not, the premium itself is a fact of behavior. Someone is willing to pay more for metal now. And that's the kind of behavior that can drag the global price higher. Now, I'm not telling you to chase. I'm not telling you to panic buy. I'm not telling you to do anything reckless. I'm telling you to think clearly. In fast markets, adrenaline makes people do dumb things. So get organized. Know what you own. Know why you own it. Know your plan before the next candle prints. And stay connected, because this can change quickly. That's why the WhatsApp channel exists. Daily updates, fast headlines, and quick context without you having to hunt for it. Also, a quick creative detour. If you want silver-related success stories, real people, real wins, and the moves that help them, there's a channel linked in the description. Go subscribe there too. Seeing how others built wealth can save you from repeating expensive mistakes. Now let me ask you two questions, and I want real answers in the comments. First, if silver tags $100 in the West, do you think that becomes a magnet that pulls price higher, or a wall that triggers the biggest shakeout? Second, where do you think real price discovery is happening right now, on paper or where people are willing to pay immediate premiums for metal? And while you're down there, if you've had any kind of success, paid off debt, grew savings, hit a milestone, share it in a sentence or two, not to flex, to motivate. You'd be shocked how much that helps other viewers stay consistent. Now, can anything stop this move? Yes, there are speed bumps. A sudden margin shock can force leverage players to liquidate. A liquidity freeze can make dealers step back and widen spreads. A surprise headline can flip risk sentiment and create violent pullbacks. So the rally can slow and it can shake people out. But here's the part most people forget. A pause doesn't automatically mean a reversal. Sometimes a market consolidates at a higher base and then continues, and it continues right when people get comfortable calling the top. That's why I say don't confuse volatility with direction. Now, pullbacks versus continuation, what to watch? One thing I want to do because it keeps people grounded is separate the headline price from the meaning of the price. Silver at $91 isn't just a quote. It's a billboard. And billboards change behavior. They change how sellers think, how buyers think, and how dealers manage risk. They also change how institutions talk about silver in meetings where for years silver barely got mentioned. You can already see that shift in the obsession with round numbers. $90, $100, $120. Round numbers attract buyers, but they also attract traps. The closer we get, the more you should expect games, fake-outs, and violent shakeouts that are designed to scare impatient money out of the trade. And every time silver starts acting like this, the narrative machine switches on. Suddenly, you'll hear, "This is the top. A massive dump is coming. The smart money is leaving." Pullbacks do happen in silver, often brutally, but notice the timing. The fear stories get loud right when the move forces the public to pay attention, because fear is a tool. Fear keeps normal people waiting. Fear keeps you second-guessing. Fear keeps you hoping for the perfect entry while the market reprices. That's why the mint pause matters beyond the product list. It's a real-world example of systems struggling to update pricing fast enough. Some silver products aren't repriced minute by minute like spot. They follow schedules and internal review. So when spot sprints, the products can temporarily become mispriced versus replacement costs, and then they disappear, and then they come back higher. That's bureaucracy meeting a vertical chart, but it still tells you the move is too fast for normal processes. Costco limits tell a similar story. They're not built to handle speculative rushes. They're built to move inventory efficiently. When they limit transactions, it suggests buying pressure is concentrated and repetitive, people coming back again and again until inventory is gone. That's what early-stage mania looks like. A smaller group draining supply before the wider public even notices. And here's the cliffhanger inside the cliffhanger. If we're seeing strain before the full public wave arrives, what happens if the public wave arrives? Because the public wave doesn't arrive politely. It arrives all at once. Now, back to futures. For one important point, margin changes are not just risk control. They're also a pressure valve. Raising margin forces leverage traders to post more collateral common traps, chasing leverage emotions, or reduce positions. And that can create forced selling. So when margins scale with price, the system is basically saying we want more collateral for this. The fact that silver pushed anyway doesn't mean it can't pull back tomorrow. It means the bid is stronger than the friction right now. So keep it practical. If you buy physical, the biggest surprise in fast markets isn't the price, it's the timeline. Orders take longer, spreads widen, products flip to unavailable. That's not always malicious. Often it's the supply chain, absorbing a surge. And if another region is paying up with a big premium, metal naturally flows that way, tightening availability elsewhere, even if your local spot quote looks fine. So watch the real indicators. Are your favorite products staying in stock? Are premiums rising? And are delays getting longer? And one last community reminder. If you want to stay calm during moves like this, you need daily context, not one viral candle. That's exactly why the WhatsApp channel exists. Quick daily touch points so you don't get emotionally whiplashed by a single headline. Because in silver, the people who win are usually the people who had a plan before the chaos.